The setup. Price versus size silver was trading near $76 when the positioning shift appeared. Volatility had already increased earlier in the week, and sentiment across retail forums and futures desks was cautious. The price was not collapsing, but it was clearly under pressure. In that environment, size began to show up. Reports circulated that positioning equivalent to roughly 50 million ounces had moved through the futures market. In COMEX terms, that represents approximately 10,000 contracts, since each contract controls 5,000 ounces. For context, that is not a small adjustment or a routine retail flow. It represents institutional scale exposure. The first question professionals ask in a situation like this is not emotional. It is structural. If price is weak and size increases, what does that mean? Is it directional conviction? Is it hedging? Is it delivery preparation? Or is it simply liquidity provision during volatility? He did not assume intent. He looked at context. Silver's annual global mine supply is roughly 830 million ounces. A 50 million ounce position is about 6% of that annual figure. That comparison does not mean the full amount will demand physical delivery. Futures positioning does not automatically equal physical withdrawal. However, scale still matters. When positioning reaches that size in a compressed time window, it signals that large capital is active. At the same time, another layer of tension existed in the market, the difference between screen price and physical retail pricing. While spot hovered near $76, many retail outlets were quoting physical silver closer to $85, $90 depending on product and region. Premiums had not collapsed with spot. In some cases, they remained elevated. That gap is not unusual during periods of volatility. Futures markets are highly liquid and react quickly to macro headlines. Physical supply chains adjust more slowly. Fabrication costs, wholesale inventory cycles, and retail demand all influence premiums. Still, when spot softens while physical pricing remains firm, analysts describe it as a short-term liquidity imbalance rather than a definitive trend signal. He observed that open interest remained relatively high compared to registered inventory levels. That ratio does not automatically imply stress. It reflects the leveraged nature of futures markets, where contracts frequently offset before delivery. But when volatility increases near macro catalysts or delivery windows, positioning data becomes more relevant. This was not occurring in isolation. A CPI release was approaching. Treasury yields had been fluctuating. The US dollar index was showing signs of strength in recent sessions. Silver, unlike gold, carries both monetary and industrial sensitivity. It often reacts to real yield movements and dollar strength more sharply than gold does. From a macro perspective, silver at $76 was not historically extreme. It had traded above that level recently and had corrected lower during liquidity-driven sell-offs in prior cycles. What made the moment notable was not the price itself. It was the size of positioning appearing into that weakness. Professionals distinguish between three broad possibilities in such situations. First, hedging. A large industrial user or bullion bank may hedge exposure ahead of macro uncertainty. If CPI surprises to the upside and yields rise, silver could face pressure. Hedging in advance would be rational risk management, not directional speculation. Second, tactical accumulation. Some institutions increase exposure during volatility when liquidity is available and sentiment is cautious. They view weakness as an entry opportunity if longer-term fundamentals remain constructive. Third, delivery positioning. Futures markets periodically see larger flows ahead of first notice days or contract rolls. Participants adjust exposure based on inventory planning, financing conditions, or arbitrage opportunities between exchanges. None of these interpretations require extreme narratives. They reflect routine institutional behavior. The 50 million ounce figure gained attention because it appeared within a short time window. In futures markets, size clustering often attracts algorithmic attention and short-term traders. When one large participant moves, liquidity providers adjust spreads. Volatility can expand temporarily. However, a single session does not define trend direction. He reviewed ETF flow data. Exchange-traded products tied to silver had shown mixed activity. There was no immediate confirmation of massive inflows or outflows aligned with the reported futures positioning. That suggested the activity might have been isolated within derivatives rather than part of a broad retail surge. He also examined volatility metrics. Implied volatility had increased but was not at crisis levels. That implied the market was alert but not destabilized. In prior dislocation periods, volatility spikes were sharper and accompanied by liquidity withdrawal. That was not clearly visible here. Another layer to consider was dollar behavior. When the dollar strengthens, commodities often soften in nominal terms. If the 50 million ounce positioning coincided with dollar strength, it could represent a macro hedge rather than a silver-specific bet. He avoided overinterpreting a single data point. Markets are systems. One variable rarely explains everything. Still, he acknowledged that size matters. Institutions do not deploy exposure at scale without analysis. Even if the intent is hedging, it reflects preparation for movement. Preparation implies expectation of volatility. The next 72 hours were relevant not because of drama, but because of alignment. CPI data, yield reaction, dollar response, and futures positioning would intersect within a compressed time frame. When macro catalysts meet concentrated positioning, markets often reprice quickly. The structural question was simple. Would price adjust toward positioning, or would positioning unwind toward price? If silver stabilized above short-term support and volatility compressed, it would suggest the large positioning was not immediately under stress. If price extended lower and volume increased, it might indicate that the flow was part of broader hedging or risk reduction. He remained disciplined. He did not label the move as confirmation of a breakout. He did not describe it as evidence of manipulation. He framed it as imbalance. Price was soft, size was large, premiums were firm, macro catalysts were approaching. That combination creates tension. In markets, tension resolves through movement, sometimes upward, sometimes downward, often sideways before clarity emerges. The role of analysis is not to predict with certainty. It is to identify where pressure may build. Silver at $76 was not simply a number. It was a point where liquidity, macro uncertainty, and institutional positioning intersected. The 50 million ounce exposure was not a verdict. It was a variable. Over the coming sessions, confirmation would not come from headlines. It would come from yield direction, dollar response, ETF flows, and delivery behavior. He watched those variables carefully. Because in professional markets, conviction is not measured by emotion. It is measured by size deployed during uncertainty. And size had just appeared. Liquidity windows and the quiet mechanics behind size. When large size appears in a futures market, professionals do not immediately focus on direction. They focus on liquidity conditions. Futures markets are structured around liquidity windows, specific hours, data releases, and contract cycles when volume expands and spreads tighten. If a participant intends to move meaningful size, those windows matter. Silver's positioning shift occurred during elevated volatility. That detail is important. Volatility increases both risk and opportunity. It widens intraday ranges, improves liquidity depth, and allows larger orders to be absorbed without immediately distorting price beyond repair. Institutions understand this dynamic well. He examined intraday structure instead of headlines. Volume expanded into weakness, not strength. That pattern often suggests absorption rather than momentum chasing. In simple terms, when price falls but volume rises and does not collapse further, someone is willing to take the other side. However, absorption alone does not confirm bullish conviction. It may represent structured risk transfer. Futures markets exist so that one participant can reduce risk while another assumes it. A miner may hedge future output. A bullion bank may balance exposure. A fund may reposition capital ahead of macro data. The mechanics are rarely dramatic. They are operational. The scale, 50 million ounces, sounded large in retail discussion, but within institutional frameworks, it is evaluated relative to liquidity capacity. COMEX silver often trades hundreds of millions of ounces in notional volume daily when accounting for turnover. What makes size notable is not just its total amount, but how concentrated it appears in time. He noticed clustering. Orders appeared within compressed intervals rather than being distributed evenly throughout sessions. That behavior can reflect urgency. Urgency does not necessarily mean fear or confidence. It often means constraint. A fund rebalancing before month end, a desk adjusting exposure before CPI, or an arbitrage window opening between exchanges can all create time-sensitive positioning. He also considered financing conditions. Futures are leveraged instruments. Participants post margin rather than full notional value. When volatility increases, margin requirements can shift. That can either force liquidation or create opportunity for those with available capital. In past cycles, institutions with excess liquidity have used margin-driven weakness to establish exposure at more favorable levels. Another element was the contract calendar. Silver futures rotate through delivery months, and positioning behavior changes as first notice days approach. Traders who do not intend to take delivery often roll contracts forward. Those who intend to stand for delivery must maintain exposure through specific dates. As delivery windows tighten, open interest dynamics shift. At $76, silver was not trading at extreme historical lows, but it was trading below recent highs. In correction phases, markets test conviction. Weak hands reduce exposure first. Larger participants evaluate whether structural fundamentals justify increasing risk. He reviewed industrial demand signals. Silver carries dual identity, monetary metal and industrial input. Solar fabrication, electronics, and emerging technologies continue to consume meaningful quantities annually. Industrial demand does not adjust overnight. It responds to economic cycles, not single data prints. If industrial buyers anticipate stable or rising demand into coming quarters, they may use price weakness to hedge forward needs. That would not be visible immediately in retail premiums. It would appear first in futures positioning. He also observed ETF stability. If exchange-traded silver funds were not showing heavy outflows during price weakness, it suggested that longer-term holders were not exiting aggressively. Stability in ETF flows during volatility often indicates that selling pressure is tactical rather than structural. The premium gap remained a point of analysis. Spot near $76, while retail pricing hovered closer to $85, $90, reflected supply chain inertia and fabrication cost layers. Futures contracts represent unallocated metal exposure. Physical coins and bars represent fabricated, distributed products with fixed overhead. In periods of volatility, the spread between those two can widen temporarily. Professionals interpret widening spreads carefully. If premiums expand alongside falling spot and inventory tighten simultaneously, that can signal stress in physical distribution. If premiums remain elevated but stable while spot fluctuates, it may simply reflect slower retail repricing. He did not interpret the premium gap as proof of shortage. He framed it as friction. Markets operate through friction. Futures are frictionless relative to physical. They move quickly because they represent financial exposure. Physical markets move slower because they involve production, shipping, and storage. The more interesting observation was behavioral. The 50 million ounce positioning did not trigger immediate breakout behavior. Price did not surge vertically. That restraint suggested the positioning was not aggressively lifting offers across thin books. It appeared more methodical. Methodical positioning typically aligns with institutional risk frameworks. Large desks often slice orders algorithmically to minimize impact. When such activity still registers as visible clustering, it implies size significant enough to exceed routine background flow. He then looked at cross-asset relationships. Treasury yields were reacting to inflation expectations. The dollar index showed resilience. Gold was stable relative to silver. Historically, silver tends to amplify gold's movement in both directions due to its industrial sensitivity. If silver underperforms gold during dollar strength, it may reflect macro caution rather than metal-specific weakness. The upcoming CPI release added another dimension. Inflation data can alter rate expectations quickly. Rate expectations influence real yields. Real yields influence precious metals. Positioning ahead of CPI often reflects scenario hedging rather than directional certainty. Within that framework, the 50 million ounce shift could represent a volatility hedge. If CPI surprised lower and yields fell, silver could rally. Holding exposure ahead of such an event provides upside participation. If CPI surprised higher and yields rose, futures liquidity would allow rapid adjustment. He focused on asymmetry. Institutions evaluate whether downside risk is limited relative to upside potential. At $76 after a correction phase, some may have judged risk-reward as favorable within defined parameters. Still, confirmation required follow-through. One session of size does not create a trend. Trends require alignment, macro support, flow continuation, and technical stabilization. He outlined the variables to monitor in the coming sessions. Does open interest expand or contract? Do ETF flows confirm accumulation? Does price hold structural support levels? Does the dollar strengthen or soften post-CPI? These questions mattered more than the headline number. In professional markets, narrative follows structure, not the reverse. Structure here consisted of price weakness, visible size, elevated but stable premiums, and a macro catalyst approaching. He described it as a pressure chamber. When liquidity, leverage, and macro uncertainty intersect, markets compress before release. The release does not always occur upward. It occurs where imbalance resolves. Silver's imbalance was not yet resolved, but size had entered the equation. And when size enters during uncertainty, experienced observers pay attention, not because of speculation, but because of positioning discipline. The next sessions would determine whether the 50 million ounces represented preparation for expansion or simple risk transfer within a volatile window. Until then, the mechanics mattered more than the narrative. Delivery math, risk transfer, and the real test of conviction. By the third session after the positioning shift, attention moved away from headlines and toward math. Markets often begin with narrative, but they resolve through numbers. Silver was still trading near the same zone, fluctuating around $76, and the reported 50 million ounce exposure had not triggered a decisive breakout or collapse. That stability forced a deeper question. What does conviction look like in futures markets? Conviction is not declared. It is revealed through behavior as contracts approach delivery thresholds. COMEX silver contracts represent 5,000 ounces each. With 10,000 contracts roughly equivalent to 50 million ounces, the positioning was significant but not dominant relative to total open interest. Open interest across active contracts often measures in the hundreds of thousands. That means even large flows must be understood proportionally. He examined the relationship between open interest and registered inventory. Registered inventory refers to metal that is eligible for delivery against futures contracts. Open interest represents outstanding contracts. most of which will not result in physical delivery. Historically, only a fraction of contracts stand for delivery. The rest are offset or rolled forward. That ratio can appear large, but it reflects leverage, not immediate shortage. However, during periods of elevated positioning into delivery windows, analysts monitor whether open interest declines smoothly or whether contracts persist unusually close to first notice day. If the 50 million ounce exposure represented intent to stand for delivery, open interest in that contract month would remain elevated deeper into the delivery window. If it represented tactical trading, contracts would likely be rolled or closed before delivery deadlines. He avoided dramatic conclusions. He described it as a test of follow-through. Another layer involved financing conditions. Futures positions require margin. If volatility expands, margin requirements can rise. Participants must maintain sufficient capital to hold exposure. Large funds typically plan for such scenarios. Retail traders often do not. Therefore, volatility tends to flush weaker hands first. If the 50 million ounce position remained stable through volatility, it would indicate disciplined capital allocation. If it quickly unwound under pressure, it would suggest opportunistic trading rather than structural accumulation. He also considered basis relationships, the difference between futures prices and spot prices. When futures trade at a premium to spot, the market is in contango. When futures trade below spot, it enters backwardation. Changes in basis can signal shifts in financing demand or delivery preference. At $76, the curve structure was relatively stable. There was no dramatic inversion suggesting immediate stress. That suggested the market was not signaling panic in physical supply. Instead, it reflected a liquid derivatives market adjusting to macro uncertainty. He turned attention to cross-market arbitrage. Silver trades globally across exchanges. If price discrepancies emerge between regions, arbitrage desks exploit them. For example, if futures pricing diverges from international spot benchmarks beyond transaction costs, traders will adjust exposure until equilibrium returns. Large positioning may reflect such arbitrage dynamics rather than directional bets. A desk may buy futures in one venue while hedging physical exposure elsewhere. That behavior can produce large contract numbers without implying a speculative view on price. He then reviewed the gold to silver ratio. Historically, that ratio expands during risk aversion and compresses during economic optimism or precious metals rallies. If silver underperformed gold significantly during the positioning window, it would indicate industrial sensitivity dominating monetary demand. The ratio had widened modestly, but not dramatically. That suggested the move was more about silver-specific liquidity than broad precious metal distress. He paid particular attention to ETF activity again. ETFs act as bridges between physical and financial markets. Significant inflows or outflows often accompany major price shifts. During this window, ETF activity appeared contained. That supported the interpretation that futures markets were adjusting internally rather than reacting to widespread investor reallocation. The premium spread remained a key signal. Retail pricing still hovered above spot, but premiums were not accelerating rapidly. That implied stable, not explosive, physical demand. If structural shortage were developing, premiums would likely expand more aggressively. He reframed the discussion. The significance of 50 million ounces lies less in the absolute number and more in timing. It entered during a volatility window ahead of macro data and near delivery considerations. Timing can reveal intent. Institutional participants often act before catalysts rather than after them. They price scenarios in advance. If CPI were to surprise lower and yields decline, silver could benefit quickly. If CPI surprised higher and yields rose, silver might test lower levels. Holding exposure ahead of such events reflects calculated asymmetry, not certainty. He constructed a simple decision tree. If CPI weakens the dollar and lowers real yields, does silver respond proportionally? If CPI strengthens the dollar and lifts yields, does silver break structural support? The 50 million ounce exposure would be measured against those outcomes. Conviction persists when markets move against a position and it remains intact. Tactical trades often exit quickly when thesis friction increases. He also monitored volatility compression. After initial expansion, markets often enter narrowing ranges before decisive movement. Compression following large positioning can indicate absorption. Expansion after compression can indicate breakout attempts. Silver's range had narrowed slightly. That suggested equilibrium building rather than immediate rupture. He avoided assigning motive. Instead, he described layers of risk transfer. One participant reduces exposure, another increases it. That exchange is the core function of futures markets. The 50 million ounces represented such a transfer. What makes certain transfers notable is persistence. If positioning continues in the same direction over multiple sessions, the pattern becomes structural rather than isolated. He emphasized patience. In financial markets, confirmation rarely arrives in the same session as size. It arrives through alignment, macro confirmation, flow continuation, and technical validation. Silver near $76 had not yet delivered that alignment. It had delivered tension. The market now faced a simple measurement phase. Would open interest expand or contract? Would ETF flows shift meaningfully? Would premiums widen or normalize? Would yields drive decisive movement? Until those answers emerged, the positioning remained a variable, not a verdict. He concluded that professionals watch behavior, not noise. Behavior in this context meant how exposure evolves under stress. If the 50 million ounce position persists through volatility and delivery thresholds, it will speak clearly. If it fades quietly, it will confirm tactical timing rather than structural intent. Either outcome provides information. And in markets driven by leverage and liquidity, information, not speculation, defines advantage. When imbalance meets catalyst, the decision phase. By the fourth stage of observation, the market was no longer focused on the headline number. It was focused on response. The reported 50 million ounce positioning had entered the system. Silver was still fluctuating near $76, and volatility had not escalated into disorder. The environment had shifted from reaction to evaluation. At this point, experienced participants stopped asking who bought and began asking what must now happen for that positioning to make sense. Markets operate on thresholds. Below certain levels, risk increases. Above certain levels, confidence expands. Silver was hovering near an inflection zone where both outcomes were plausible. The next catalyst, macro data, yield movement, or delivery dynamics, would act as a stress test. He examined real yields first. Precious metals tend to respond inversely to real yields. If inflation expectations rise faster than nominal rates, real yields compress, often supporting metals. If nominal yields rise sharply without inflation relief, real yields expand, pressuring metals. The upcoming data release would influence that equation. If real yields softened, silver could stabilize and test higher resistance levels. If they hardened, the metal could retest support. The 50 million ounce exposure would be evaluated through that lens. Did it anticipate yield softening, or was it structured to hedge yield expansion? He also assessed dollar behavior. The US dollar index often moves opposite commodities in nominal terms. A strengthening dollar can weigh on metals pricing. A weakening dollar can provide relief. Silver's reaction relative to dollar movement would reveal whether the positioning aligned with macro direction or was countercyclical. Another factor was volatility behavior itself. Volatility can either expand further after a positioning event or begin compressing. Compression often signals absorption and balance building. Expansion signals imbalance unresolved. In the sessions following the large positioning, silver's range tightened modestly. That tightening suggested participants were waiting for confirmation rather than reacting impulsively. Markets rarely sustain disorder without continued catalysts. He shifted attention toward technical structure. Support levels had formed during prior consolidation. If silver held above those areas despite macro pressure, it would indicate underlying demand. If those supports failed quickly, it would signal that the positioning was not sufficient to stabilize price. Technical analysis in this context was not about patterns for speculation. It was about identifying whether liquidity clusters were defending zones. He observed order book behavior. During tests of lower levels, bids appeared steady rather than vanishing. That stability indicated no immediate liquidity vacuum. However, it did not yet confirm aggressive accumulation either. It suggested balance. He then returned to the delivery framework. First notice day for active contracts remained within sight. As delivery windows approach, participants who do not intend to take delivery typically reduce exposure. If open interest declines smoothly into that period, it implies routine contract management. If open interest remains unusually elevated near notice day, analysts interpret it as increased probability of delivery interest. That dynamic had not yet reached a decisive point. It remained something to monitor rather than declare. He emphasized a principle. Markets reveal intent through persistence. One large positioning event can be tactical. Repeated positioning in the same direction over multiple sessions begins to suggest structural motive. So far, the flow had not been aggressively extended beyond the initial shift. That neutrality reinforced the idea that the market was in a waiting phase. The premium gap also entered its own evaluation stage. Retail premiums remained above spot, but were not accelerating sharply. If spot recovered modestly and premiums compressed slightly, it would signal normalization. If spot weakened further, while premiums widened aggressively, that would indicate physical distribution strain. Neither extreme had materialized. The gap remained stable, reinforcing the interpretation of temporary friction rather than crisis. He constructed 3 simplified pathways. In the first pathway, macro data supports metals. Real yields soften, the dollar retreats, and silver reclaims higher levels. In that scenario, the 50 million ounce exposure appears early rather than reactive. It would have anticipated the shift. In the second pathway, macro data pressures metals, silver breaks support, open interest contracts, and positioning unwinds. In that case, the exposure would be understood as a volatility trade rather than a conviction build. In the third pathway, silver moves sideways. Volatility compresses, and the market digests both macro signals and positioning quietly. In that case, the exposure would blend into broader liquidity flow without dramatic consequence. Each pathway was plausible. None required extreme narrative. He reminded himself that markets often spend more time consolidating than trending. Observers who expect immediate resolution often misread structural preparation as imminent breakout. Silver at $76 was not in panic. It was in negotiation. Large capital had entered during weakness. Macro catalysts were imminent. Technical levels were being tested. Delivery windows were approaching. That convergence defines what professionals call a decision phase. A decision phase does not guarantee dramatic movement. It guarantees clarity. Within the next several sessions, one of two things would become evident. Either the imbalance between positioning and price would resolve upward through stabilization and accumulation, or it would resolve downward through unwinding and renewed pressure. Until that resolution occurred, the disciplined approach remained the same. Monitor yields, monitor the dollar, monitor open interest behavior into delivery thresholds, monitor ETF stability, monitor premium behavior. In financial markets, clarity rarely arrives through headlines, it arrives through alignment. The 50 million ounce positioning had introduced potential. The macro environment would determine direction. And silver, positioned between liquidity and catalyst, now awaited its next signal, not from commentary, but from data. The strategic lens, what this moment teaches about capital behavior. By the fifth phase of analysis, the discussion moved beyond silver itself. The more important observation was behavioral. When large capital deploys size during uncertainty, it reveals how institutions think about risk, timing, and asymmetry. Silver remained near $76, fluctuating but not collapsing. The 50 million ounce positioning had not triggered immediate follow-through in either direction. That restraint was instructive. Markets often respond dramatically when imbalance is extreme. Here, the response was controlled. That suggested liquidity was functioning normally. He reframed the situation from price prediction to capital discipline. Institutional participants operate under risk frameworks. They define acceptable drawdowns, capital allocation limits, and time horizons. When they enter during volatility, it is usually because the expected reward relative to defined risk meets internal thresholds. This does not mean they are certain. It means they are prepared. The 50 million ounce exposure, whether hedging or directional, required margin allocation. That margin represents committed capital. Committed capital reflects scenario modeling. Large participants rarely act without probability mapping. He outlined what that mapping might include. First, macro sensitivity. Silver reacts to inflation data, real yields, and dollar trends. If models suggested that rate pressure was peaking or that inflation volatility could soften yields, then risk-reward might favor exposure near recent lows. Second, structural demand assumptions. Industrial consumption trends do not change weekly. Solar, electronics, and technological applications operate on quarterly and annual horizons. If those demand trajectories remain intact, price weakness may be viewed as temporary rather than fundamental. Third, liquidity cycles. Markets frequently overshoot during data-driven volatility. Institutions with patient capital sometimes use those overshoots to establish or adjust positions. He emphasized that none of these require dramatic interpretation. They reflect disciplined portfolio management. Silver's positioning also highlighted leverage mechanics. Futures markets allow exposure to large notional values with limited upfront capital. That leverage amplifies both gains and losses. Professional desks understand that leverage is a tool, not a thesis. If volatility expands sharply, leverage positions must be managed carefully. Therefore, persistence through volatility indicates either strong conviction or hedged structuring. He considered how this moment would appear to different participants. Retail traders might focus on the headline number. Investors with longer time horizons would focus on macro alignment. Business owners might view silver as an input cost hedge rather than a speculative asset. Each lens interprets the same data differently. The institutional lens centers on durability. Does exposure remain when price tests support? Does capital add incrementally, or does it disappear? Are flows sustained across sessions? So far, the market had shown measured behavior. There was no cascade liquidation. There was no vertical breakout. There was balance. He noted that balance itself carries information. When markets absorb size without disruption, it indicates depth. Depth reduces the probability of disorderly moves in the absence of fresh catalysts. The premium spread between futures and retail pricing continued to function as a friction point rather than a stress signal. If physical demand were overwhelming supply suddenly, premiums would accelerate rapidly and inventory reports would reflect strain. That had not occurred. He returned to the concept of structural imbalance. Imbalance is not crisis. It is temporary misalignment between liquidity and expectation. Silver's misalignment consisted of three elements: price correction into macro uncertainty, concentrated institutional positioning during volatility, approaching macro and delivery catalysts, The resolution would emerge gradually. He reminded himself that markets often transition through 3 stages: shock, absorption, and re-evaluation. Silver had passed the initial shock phase when volatility expanded. It was now in absorption. Re-evaluation would occur after macro data clarified direction. If yields eased and the dollar softened and silver stabilized above support, the 50 million ounce positioning would appear strategically timed. If yields strengthened and silver retreated and exposure reduced accordingly, it would appear tactical. Either outcome enhances understanding of capital behavior. He also considered longer-term implications. If institutional desks increasingly treat silver as both industrial hedge and macro asset, volatility may remain elevated relative to past decades. Dual identity assets respond to multiple catalysts simultaneously. That complexity attracts structured capital. The lesson was not about predicting silver's immediate direction. It was about recognizing how professional capital behaves around inflection points. Professional capital does not chase noise. It positions around structure. Silver at $76 represented a structural test. Not extreme, not unprecedented, but meaningful within recent context. The 50 million ounce exposure did not define the future. It introduced probability. He concluded with discipline rather than drama. In the coming sessions, the market would reveal whether size persists, whether macro conditions align, and whether delivery dynamics alter positioning. Until then, the intelligent approach remained steady. Observe capital persistence. Measure macro alignment. Evaluate liquidity depth. Avoid narrative shortcuts. In markets, information compounds slowly before it moves suddenly. The silver positioning event was one data point in that accumulation of information. And disciplined observers understand that advantage comes not from reacting first, but from interpreting correctly when structure and catalyst finally converge. After the noise, what the market confirms, not what it promises. By the 6th stage of observation, the discussion shifted from what might happen to what the market was actually confirming. Several sessions had passed since the concentrated 50 million ounce positioning appeared. Silver was still trading near the same broad zone, fluctuating around $76, occasionally testing higher or lower, but not breaking decisively. That behavior itself carried meaning. Markets that are structurally weak tend to accelerate downward after large positioning fails. Markets that are structurally strong tend to rebound quickly when liquidity absorbs selling. Silver was doing neither in extreme fashion. It was stabilizing. Stabilization is often underestimated. In leveraged markets, stability after volatility suggests that forced liquidation has largely passed. It suggests that weaker participants have adjusted, and stronger capital is either comfortable holding exposure or neutral enough not to withdraw aggressively. He reviewed open interest trends again. If the 50 million ounce exposure had been purely tactical and short-lived, open interest would have dropped sharply as positions closed. Instead, open interest declined gradually rather than collapsing. That gradual adjustment implied managed positioning rather than abrupt exit. He also observed that volatility had compressed further. Compression following a volatility spike is common, but its duration matters. Extended compression often precedes directional expansion. In this case, compression signaled equilibrium building around the $76 area. He examined volume distribution. Buying and selling appeared balanced across sessions, with neither side overwhelming the order book. That balance suggested liquidity providers were active and that no urgent repricing pressure dominated. The macro catalyst, inflation data, had passed. The reaction was measured. Yields adjusted modestly. The dollar moved but did not trend aggressively. Silver's response was proportional rather than extreme. This proportional reaction provided additional clarity. If the 50 million ounce positioning had been built on a narrow macro expectation that failed to materialize, price would likely have reacted sharply against it. Instead, the market absorbed the data without destabilizing. He considered what this revealed about capital durability. Durability means exposure can remain through moderate adverse movement without triggering forced unwinds. That requires margin strength and risk planning. Institutional desks design positions to withstand volatility within defined bands. Retail participants often cannot. The persistence of positioning through macro release indicated that the capital involved was structured, not impulsive. He then evaluated cross-market signals once more. Gold had maintained relative stability. The gold-to-silver ratio narrowed slightly after widening earlier. That suggested silver was not underperforming significantly anymore. Industrial sensitivity was no longer dominating the narrative. ETF flows remained stable. There were no signs of aggressive redemptions or large inflows. That neutrality reinforced the idea that the futures event was isolated to derivatives positioning rather than broad asset reallocation. Premium spreads also showed minor normalization. As spot stabilized, retail pricing adjusted incrementally. Premiums remained elevated but did not accelerate. That indicated supply chains were functioning without visible strain. He reframed the larger lesson. The market had moved from tension to digestion. The imbalance introduced by the large positioning had not triggered a structural shift yet. Instead, it created a price zone where liquidity and capital negotiated equilibrium. Equilibrium zones often act as decision platforms. They allow participants to reassess assumptions before committing to larger directional moves. He outlined what would now matter more than the original headline. Does price build higher lows above recent support? Does open interest expand again during upside tests? Does volatility expand with directional commitment rather than random spikes? If those conditions emerge, the initial 50 million ounce exposure could be interpreted as early positioning ahead of a broader move. If price drifts lower slowly while open interest declines and volatility remains muted, the exposure will be understood as temporary risk transfer within a volatile window. Both outcomes provide clarity. He emphasized patience again. Financial markets reward those who differentiate between setup and confirmation. The positioning event was a setup. Confirmation requires sustained flow. Silver's behavior suggested that capital had not exited in haste. That observation matters more than short-term price fluctuations. In professional analysis, conviction is measured by what remains after uncertainty passes. Once macro data has been absorbed and volatility compresses, remaining exposure reflects true intent more than reactive trades. The $76 area had now served as a testing ground. It had absorbed volatility, macro reaction, and concentrated positioning. That absorption implied depth. Depth reduces fragility. Fragility produces cascades. Silver was not cascading. He concluded that the market had entered a quieter but more informative stage. The next significant movement would likely require a new catalyst, either macro-driven or delivery-related. Until that catalyst appears, the correct posture is observation rather than anticipation. The initial 50 million ounce figure attracted attention. The subsequent sessions delivered insight. They showed that capital entered during weakness, endured macro release, and did not flee immediately. In financial systems built on leverage and liquidity, endurance often matters more than speed. Silver's current state reflected endurance. And endurance, when combined with compression, often precedes decision. The direction of that decision remains open, but the structure is now clearer than when the number first appeared. The compression zone, where markets decide. Quietly. By the seventh stage of evaluation, silver was no longer reacting to headlines. It was responding to structure. The earlier 50 million ounce positioning had now moved from being a disruptive event to becoming part of the background architecture of the market. Price remained near the mid-70s, fluctuating within a narrowing range. That narrowing range was not random. It reflected compression. Compression is a phase where volatility contracts after a shock. It often occurs when buyers and sellers reach temporary balance. During compression, the market builds energy. The longer the compression lasts, the more significant the eventual expansion tends to be. Silver's daily ranges had tightened. Intraday spikes were smaller. Volume was steady but not aggressive. That pattern suggested neither side felt urgent enough to force a breakout. Instead, capital was assessing. He examined the relationship between open interest and price during this compression phase. If open interest increases while price remains stable, it suggests new positions are being built without moving the market significantly. If open interest declines while price stabilizes, it suggests older positions are quietly closing. Recent data indicated moderate stability in open interest. It was not surging. It was not collapsing. That neutrality reinforced the interpretation of equilibrium. Equilibrium zones are critical. They reveal whether prior positioning was speculative or strategic. If speculative, exposure tends to evaporate quickly once volatility fades. If strategic, exposure remains steady and occasionally increases quietly while price holds support. He also looked at the order flow characteristics. Bid depth at key support levels appeared consistent. That consistency implied that liquidity providers were comfortable defending those zones. Offer pressure near resistance was present but not overwhelming. This type of order book behavior often precedes directional commitment once a catalyst appears. The macro backdrop had temporarily stabilized. Inflation data had been absorbed. Treasury yields were consolidating. The dollar was trading within a defined band. In the absence of new macro shocks, silver's internal structure became more relevant than external narratives. He shifted focus to positioning psychology. When large capital enters during weakness and the market does not immediately reward it, patience becomes the test. If exposure remains, despite lack of instant upside, it signals measured time horizons. Short-term traders typically require rapid validation. Longer-term participants tolerate consolidation. Silver's lack of rapid breakout suggested that participants involved were not chasing quick momentum. They were likely operating within broader frameworks. He revisited the gold-to-silver ratio. A stable or slightly narrowing ratio during compression indicates that silver is not disproportionately weak. That relative stability helps define whether silver-specific stress exists. The ratio's behavior suggested no abnormal divergence. He then addressed a subtle but important factor: sentiment fatigue. After volatility events, retail sentiment often swings sharply. But as compression extends, attention fades, fewer emotional reactions appear. This quiet period often coincides with institutional positioning because noise decreases. Markets rarely make decisive moves when attention is at its peak. They often move after attention declines. Silver appeared to be entering that quieter zone. He considered 3 structural signals that would indicate compression resolving: a decisive close above recent resistance with expanding volume, a break below support accompanied by rising volatility, a continued sideways drift that gradually builds a base. At present, the third scenario dominated. Sideways drift was building a base-like structure. Bases are not guarantees of upside. They are platforms from which movement becomes possible. If underlying demand exists, bases support upward continuation. If demand fades, bases eventually break lower. He emphasized again that the 50 million ounce positioning was now less important than what followed it. The market had absorbed it without disorder. That absorption reduced immediate downside fragility. He examined correlation patterns. Silver's correlation with risk assets remained moderate, but not extreme. It was not behaving as a panic asset. It was behaving as a consolidating commodity. That behavior reinforced the idea that the market had transitioned from reaction to preparation. Preparation phases are subtle. They lack drama, but they are where large trends are often born. He described the current environment as a compression zone between liquidity and catalyst. The earlier positioning event introduced potential energy. Compression stored it. The next expansion would likely depend on fresh macro inputs, delivery cycle dynamics, or broader commodity flows. He summarized the structural characteristics now visible: stable, open interest, narrowing price range, moderating volatility, contained ETF flows, gradual premium normalization. None of these elements indicated crisis. They indicated balance. Balance is not the end of movement. It is the beginning of directional clarity. He concluded that silver had entered its quiet decision stage. The initial shock of large positioning had passed. The market had digested it. Compression had formed. What matters now is not the memory of the 50 million ounce figure, but the behavior that emerges from this compressed structure. In leveraged markets, compression followed by expansion defines opportunity. The only remaining question is direction, and direction will not be declared in advance. It will reveal itself through volume, volatility, and persistence. For now, silver remains in negotiation. And negotiations in financial markets often end not with noise, but with movement that surprises those who stopped watching during the quiet.